We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth. Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin. And it has been a crazy couple of weeks financially. So we're going to go right into our Wallet Watch segment. Joining us is Wallet Watch contributor and financial advisor, John Ruoco. John, it's good to have you today.
Yeah, thank you, Eric. It's very good to be here.
So the markets have been going crazy. They've been on a roller coaster. We got new Fed minutes this week. What can you tell us about what's going on?
Okay, so just the backdrop of the whole scenario is that the whole market, the stock market and investors in general have been accustomed to the fact that the Fed has always been able to lower interest rates to bail us out of our problems, whatever our problems are. And this all started way back in the 1980s after we went through a big inflationary spiral and high interest rates of the 70s and the early 80s. And rates have been coming down ever since, up and down, but generally down. And then they really started to hit bottom back when we had the mortgage crisis in 2008. And at that point, interest rates came down to virtually zero for as far as the Federal Reserve is concerned. They brought all their interest rates right down to the bone. And then they started this process of printing money and creating money. And in the past couple of years, since we went into the pandemic mode, the market collapsed because the economy was being shut down and the Federal Reserve said they can print money for ever. Until infinity, they said, and they do this by buying bonds off the market in order to keep interest rates as low as possible, because this is how the system works, and I can get into it more about, I don't know if I have time, but the bottom line is that over the past several months, the Fed has been signaling that they're going to have to remove this heroin that the market is on. They have to stop feeding the market all this cash. And it's the cash that's floating around in the economy that's been keeping the economy afloat, but it's also been driving the stock market. So over the past several months, the Fed has started to tell us that they're going to stop doing this. And they're they told us again on yesterday. They told us one more time that by March they expect to increase interest rates, probably by 1/4 of a point. I'm not sure what the number is going to be, but it doesn't make any difference. The market is spooked by the fact that interest rates are going to go up, which means it's going to cost more money to borrow. Speculators in the market borrow money for nothing and go out and buy stocks. And that doesn't necessarily mean, Nancy and Joe Schmo in Newington or Hartford or someplace. It's these large institutional investors that can borrow money on the cheap, and they can invest it and they make money, and that's where they make money. So when you tell them that they got to pay more for that money, that's a scary prospect, because they're only looking at a skinny margin in terms of what their profits are. And so that's taking the punch bowl away from the market speculators and the whole economy in general. It's going to hurt, it could, hypothetically, if rates go high enough, it would hurt the housing market. It would hurt small businesses from borrowing money. It'll affect everyone on their credit cards. It's going to affect your car loan. So this is why the market gets spooked about the higher interest rates. Along with that, this past week or two or three or four or whatever, we've had this buildup of situations in the Ukraine, and you have China doing all these things to focus on whatever they're going to do in Taiwan. And you have Iran, who is running a little bit loose, and you got, North Korea that's firing missiles out into the ocean. And the whole thing is getting everybody to be very jittery. So it's a lot. It's the primary mover is interest rates that's scaring investors. And the backdrop of that at the same time is this coming together of a lot of political type events that are affecting investors. So that's what's causing the jitter. So what we have to do is we're going through an adjustment period, and the markets and the investors are going to have to adjust to the fact that we may see slowly rising interest rates throughout the next year. And the big question on everyone's mind is how fast will those rates actually go up? And that's what they don't know, and they're all trying to figure out.
So for individual investors, what can they do given all of the volatility? I mean, we've talked about how investors especially need to be looking at the long term, and don't check the portfolio value every day, because that's just going to give you stress. But for those people who maybe are getting closer to retirement, or they're getting a little nervous about their investments, what can they do to protect themselves, or even just calm themselves?
Right. Yeah, that's the major question that everybody asks. What I do is I go through my client list whenever we get into these volatile periods, and I look for the clients that need the money the most. And by that, I mean, they're either near retirement or they are retired. And I have a number of those that are living off of their portfolio. And the people who need the money are the ones that have to preserve their principal. If you don't need the money, you can ride these things out. And if you're smart and you're a good investor, you would always maintain some reserves in terms of cash or bonds or short-term instruments of some kind. And this is an opportunity, and may not be today, but hopefully this is an opportunity that you would slowly start adding cash and investing for the long term. But if you're already retired, you can't run the risk of having the markets go down for an extended period, which could be a year or 2 or 3, and at the same time you're drawing principal out of that portfolio, and that's going to affect your long-term income. So that's kind of, you got to kind of weigh that out. What is the impact of where you stand personally versus a simple formula of don't worry about it, it's the long term. Well, it's the long term for everybody, but the bottom line is that you can't put a retiree, if you're retired, you don't want to run out of money, so you have to be cautious. And it doesn't hurt if you're depending upon how close you are to that margin, it doesn't hurt to take money off the table. But for others, it's a good time to invest. And this is kind of what I do as an advisor, is work with people to make those decisions, and not to push my own business, but my business is managing the money of those people. So I just do it for them. And but that's my thinking process. My thinking process is, how bad do these people need the money, and can they afford to take a 10 or 15% hit? If so, that's fine. We can ride through these things. But if not, I have to decide that I have to maybe back off some of this if that's the case.
So for an individual, they should really be evaluating whether or not they need the money immediately that's in their investment portfolio. And for folks that are, say, in their 40s or 50s and they're investing for retirement, that's still 10, 20 years down the road, they really shouldn't be that concerned about the volatility.
Yeah, that's in general, that is true. Yes, that is true. You know, yeah. I could expand. I mean,
That-
it's not, the problem is it's just not that simple because,
Right.
the money is a very emotional thing. And I have they say, well, you got to be cautious if you're older. I have clients that are 80 years old that aren't worried about anything. And I have people that are 40 years old that are very worried. And I have people that have a lot of money that are very worried, and people that have almost no money. When I say no money, not a lot of money, and they're not worried at all. And they should be worried. The ones that don't have any money should be really worried. And they're in a lot of cases, they're not. And the ones that have plenty of reserves are the ones that are most panicked about all these things.
Right. So I guess the best advice we can give our listeners is pay attention to your individual situation.
Yeah.
You should be more concerned about how your portfolio matches your situations rather than general market conditions.
Exactly. And that is exactly true. And people tend to focus on, am I beating the market? Am I doing this? Am I doing that? It's not all about all of that stuff. It's really about, where do you stand? And you said it very well. Where do you stand? And are you doing what you're supposed to be doing? And are you ahead of the game? And not get too focused on the fact that, well, there's this great stock that I should have bought and I should have done this. And this is what'll make you crazy.
All right. Thanks for joining us this week, John. That's the Raw Naked Truth. You can catch every episode at xvadio.com/podcasts, as well as the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.
Bye.